The answer is a resounding no. It's not even close. Your investment of $750 in your Roth account each year has turned into almost $63,000. $62,851 to be precise. Meanwhile, poor Megan's investments of the exact same amounts, made at the exact same time, at the exact same assets, are worth only $47,814. That's a difference of over $15,000, or about 25% less. That's no coincidence. Remember what your tax rate is? It's 25%. That makes sense when you think about it. Megan is earning 25% less because the government takes 25%, so she's left with about 25% less when all is said and done. How much would you have had if you had invested in a traditional IRA, the kind that lets you deduct your contribution from taxable income on that year's tax return, but then has the total investment subject to income taxes at withdrawal? It turns out that it's exactly the same as the Roth IRA. If the tax rates during the accumulation phase are the same as at withdrawal, then a Roth and a traditional IRA yield the same amount. That's because the upfront tax deduction on the traditional IRA offsets the tax exemption on the Roth's earnings. The two types of IRA won't deliver the same amount if tax rates on the funds you invest differ from the ones in effect at withdrawal. If the tax rates are lower while you're withdrawing, then the traditional IRA will be worth more. And if the tax rates are lower when you're saving, then the Roth will be worth more. When comparing a Roth IRA with a traditional IRA, you want to take the tax hit when it will cost you the least. Just about anyone can open a traditional IRA. You just have to have earned income during the tax year of the contribution, and you must be less than 70 and a half years old by the end of the year. To the IRS, earned income is stuff like wages, salary, fees, commissions, and for the most part, self-employment income. Investment income doesn't count. You run into some income restrictions that limit the tax advantages of IRAs, though, and we'll talk about those in a minute. The eligibility rules are a bit different for a Roth IRA. The biggest difference is that if you exceed the income limits, then you can't make a contribution directly to a Roth account at all. We'll learn a way around that later, though. Rest assured that when you open your IRA, you won't be alone. The Investment Company Institute says that at the end of 2010, IRAs held total assets worth $4.7 trillion. That's just under 10% of U.S. households' total financial assets. That $4.7 trillion was more than a quarter of all U.S. retirement assets. Almost 50 million U.S. households owned at least one IRA at the time of the survey. That was over 41% of U.S. households. You'll have a lot of company when you open your IRA. You don't need to have a bunch of money to open an IRA either. Lots of those $4.7 trillion worth of accounts are small. The Investment Company Institute says that accounts held by investors between the ages of 25 and 29 average just over $8,000 at year-end 2007. That's not an annual contribution, mind you. That's the total account value. People between the ages of 70 and 74 hold the biggest IRAs, but even those average just over $162,000. Once you've opened your account, you fund it with cash, a check or an electronic transfer, for example. You can't put stocks directly into your IRA. Of course, once you've made your contribution, then you can use it to buy other investments, including stocks. People invest the biggest chunk of IRA assets in equities and equity mutual funds. For example, traditional IRA investors had 57.8% of their IRA assets invested in individual stocks, equity mutual funds, and equity exchange-traded funds at the end of 2007. Mutual funds were managing almost half of all IRA assets at the time, 48%. Traditional IRAs and Roth IRAs are great investment tools.